Netflix is up over 13% in the past 2 trading days after announcing earnings Tuesday afternoon after hours. So the beats with earnings were relatively minimal, but the price increase on the market has been substantial. So what's going on here? What did they announce in the conference call that's got everyone so excited? We're going to go over those things here in a moment. We're going to look at their fundamentals. We're going to go over what was talked about on the earnings call on Tuesday. And we're going to talk about if Netflix is a good buy right now. In fact, I do think it's a good buy. I think it's going to make people money over the next 5 years. But is it a good value? Is it something that I'm considering buying at the current price? And if not the current price, what price? Let's get into it. Welcome to the channel, y'all. My name is Trey. This is Investing by Numbers. We talk about the stock market, stocks, other areas of investment. So if you're looking to push your knowledge in those areas to new heights, please like and subscribe and follow us. We do a lot of educational content and just review certain stocks. All right, so number one, earnings per share for Netflix announced Tuesday evening was $4.27 a share versus the estimate of $4.20 a share for the fourth quarter. So it's a beat, not huge, but it's a beat. Revenue was announced $10.25 billion versus the estimated $10.11 billion. But the thing that I'm excited about the most was we had 16% year-over-year growth. I mean, the previous year had only 6.7 year-over-year growth. So 16% is a great improvement.
Object to the text!
The second thing to talk about is Netflix had 19 million new subscribers in 2024 and surpassed the 300 million paid memberships mark. Great numbers there. That's awesome. Also, one thing they brought up on the conference call was 60% of the revenue comes from outside the U.S. So yes, still 40% is a big number that comes from the U.S., but these are great metrics because it just shows that if one specific area, including the United States, if we have a couple years where the economy is in bad shape, there's still so much area for growth when it comes to Netflix and just other streams for revenue. So number three, Netflix will go from subscriber updates quarterly to engagement reports. So what's going on here? Why the change? Well, what Netflix is doing now is offering a cheaper tier that has ads instead of the full amount that we've been paying if you're a Netflix subscriber for 0 ads. So the new cheaper ad supporter tier is now up and running. We're having a new influx in revenue when it comes to the ad portion of Netflix. So companies will now be paying Netflix to push their advertisements. So now the number to look at isn't as much subscribers as it is engagement. I mean, how many viewers and how long, how are they seeing these ads? And that's really going to be what pushes Netflix into the new sector of ad revenue, which is a really great area for them to move into because, that level of where the ceiling is for the revenue for what they have is now raised and a whole new side of the business is brought in, selling ads.
This is the greatest advertising opportunity since the invention of cereal.
The fourth thing that was brought up in the conference call I want to go over was a question that came up, and basically the question was the growth in revenue for the quarter and the year primarily coming from that new sector in the sports streaming? And what they said was no, the influx in revenue was not reliant upon the sports streaming that Netflix has moved into, which is great because we still are getting great revenue income from the shows and series, but also now we do have the sports streaming. They have the boxing matches, the wrestling, the NFL games, and those are just continuing to grow Netflix's revenue. But it shows that the other sectors are still doing really well in their business model and that these new areas still haven't been completely tapped into. So there's still tons of room and engagement to happen with the new sports related content that Netflix is pushing for the platform. So that's really great news. Number 5 was that Netflix is raising prices $1 to $2 depending on the subscription tier of the consumer. And this is really great. Obviously, no one likes price increases. So if you do pay for Netflix, no one likes that they're raising prices. However, in the history of Netflix, we've seen that people are willing to pay most of the time whatever Netflix gives them. And also, net income is basically where we see the number go up when they raise prices. So the fact that they're raising prices $1 to $2 just shows that more earnings per share will be affected for the better when it comes to these raising of prices. Netflix is one of the services that people they're willing to pay more money. And anytime in the past Netflix has raised its costs to consumers, Netflix has seen profits increase. So if you're a shareholder, this is a good thing, and it should make up for the $1 or $2 a month that you might be paying extra for your own subscription. So let's go over some fundamentals for Netflix here. I've got macro trends pulled up. This is the site I like to use when going over the fundamentals. If you're new here with us, I have posted a video that'll link at the end of this video. I've got a 5-part checklist of how to find great stocks to invest in at a good value, so you can beat the market moving forward. And we're going to go through those things right here, right now. But watch that video. It's got a lot of great information in it when you get to the end of this video. So looking at the Netflix revenue chart here, this is exactly what we want to see. Over the last 10 to 15 years, we have seen revenue increasing. I mean, looks awesome. And we had a little bit of a plateau, around this area, a small decrease here quarterly, but overall we have increasing revenues with the most recent quarter being the highest. Net income, let's check that out. We also want to see net income increasing over time, and that's exactly what we see. Obviously, we've had some dips in quarterly net income, but overall, we are seeing a gradual increase, with the most recent quarter having the highest net income. This looks great. So that means revenue is increasing and net income is increasing. And if we're investing in something, that's really what we want to see. We want to see both of those numbers increasing over the long term. Okay, so let's check out the balance sheet and what they got for cash on hand. I like to see increasing cash on hand over time, and that's exactly what we see. With the newest quarter, of course, we reported all-time highs as far as cash on hand. Let's go back to the balance sheet, and we want to look at the ratio of total assets to total liabilities. So we got total assets. We got almost 49 billion, over 48 billion in total assets, and we've got just over 28 billion in total liabilities, with 14 billion of long-term debt. So I like this ratio. I like to see at least a 50% more ratio of total assets to total liabilities. I really prefer to see double, but I'll go with 50% more. Also, we've got 7.1 billion of cash on hand. I mean, that would cover half of their long-term debt. But overall, this is a on par balance sheet, in my opinion. In the past, Netflix actually a few years ago, they were having some issues where they were building up their liabilities, and this ratio is really starting to get out of whack. And it just goes to show that they've put the work in, and they've kind of gotten a subpar balance sheet back to on par, in my opinion. So Netflix really has been putting the work in the past few years to really get the business stronger and stronger. Income statement, I like to look at just kind of the overall year-to-year increases, like in revenue and net income. As you can see, from 2018 into 2019, 15 billion to 20 billion, that's almost a 33% increase. 20 to 24, that's around a 20% increase, something like that. 25 billion to 29. Then we had kind of the last couple years were smaller revenue growth seasons. 29.5 billion to 31.5 to almost 34 billion. So these were smaller the past couple years. Obviously, we were going through some inflation during those time periods. So that's pretty expected. We saw a lot of companies most companies actually had slower revenue growths during those couple years. Coming down here to the net income, obviously we can see huge increases in net income over time. I mean, in 2018 going from 1.2 billion and then into 2023 with 5.5 billion. Obviously we had a decrease here going from 2021 to 2022, but if you look at these few years, net income has been growing, faster and larger than the revenue growth. So that that net income margin, the net margin has really been increasing, and that's really driving a lot of the sentiment, the positive sentiment around Netflix. So let's check out the PE ratio, and we're going to look at what the historical PE ratio has been, over the last 10 to 15 years, where it's sitting at right now. Right now, it's just under 50. We're at a 48.5 PE, which when you're looking at, the 16% revenue growth, it's good. Over 25% is really where it starts getting excellent. So I would say 16% year over year in this most recent year, that was good. For me, if we're in around the 15 to 20% year over year growth, I'd really like to see closer to like a 30 PE to find a good value. But still under 50 for that kind of growth is great. But the net income growth that we've seen is really adding to that. So historically, if we look at Netflix, obviously we've seen some huge PE ratios in the past. Back in 2013, it got up to 450. In 2016 or 2015, right there at the end of 15, we got up over 400. And of course, dips we've seen now. This was back in 2011, but it got all the way down to 16.7. And then most recently in the 2022 crash, we got all the way down to 15.5. But when we're looking at this, the PE ratios and kind of where they like to drop on the low ends, we got a drop here to 78.7, still pretty high. A dip here to, just around 100. But then we saw some leveling out in the past, 5 years here. Obviously, we got into the mid 70s here, dropped all the way down to below 20, and then kind of has leveled out, in the high 30s and low 40s here over the past couple years. And I would say that's on par for something like Netflix, where we're seeing that 10 to 20% revenue growth year over year. The net income growth has been even better than that. So, looking at this, obviously, they're pushing into a lot of new areas going forward. I mean, with the NFL, the wrestling, the boxing matches they're doing, they're pulling in a lot of, and then the ad revenue is going to be huge. I mean, ad revenue has got a lot of potential for Netflix to raise that revenue growth and to see better net margins. So, I think we're with those things moving forward, we're going to get back into this phase of growth for Netflix. But I really don't like to put too much weight into forward-looking outcomes. I like to look at the here and now and the past few years of what's been going on, because I like to see what the company's been doing, and I feel safer investing in that than investing in something that will probably happen. So for me, looking at the past and looking at what the kind of growth that we've seen, I'd really like to see Netflix under a 40 PE. I think that under a 40 is a pretty good value historically for Netflix. And like I said at the beginning of the video, I think right now, under 50, I think over 5 years, if you bought Netflix right now, it's pushing $1,000 a share. I think in 5 years, you will make profit on your money. Worst case scenario, we might see another crash. And I think that, it might, at year 4.5 or whatever, you could see it drop below what you paid for. And if it does that, you better buy more. You better buy more because it's going to skyrocket. We see in these crashes, like Netflix. Let's go back to the 2022 crash. Look at this thing. It dropped all the way down to below $175 a share. It was at the height almost $700 a share. This was a huge drop. Now, during this time, there was a lot of fear with Netflix. But guys, hear me out. That's when stocks drop, when there's mass amounts of fear. All right. And so us as investors like to look at what the company's done and the growth they've seen in the past and how they manage, their balance sheet and all that stuff. So, I mean, when we feel confident, when this thing started dropping, probably when it got under 30 PE, I mean, this was a great place to start buying this stock. And even if you had an average of $250 a share, you've seen a 4x going up to, where we are now, getting close to, if you had 250 and now we're pushing $1,000 a share, and that just happened in 2.5 years. That's fantastic. So it looks like Netflix is doing all the right things. They're moving into all the right areas and increasing those revenues and net incomes. So for me, I like Netflix. I like it even more under a 40 PE, but let's see what you think. Maybe you like it right now. Please like, subscribe, and we'll catch you on the next one.